You're just in time for your weekly most comprehensive look at the world of business and economics. Welcome to Business Redefined. We are now discussing the subject of the Sacco Societies Regulations of 2020, particularly focusing on the non-deposit-taking Saccos. And we're privileged to have the Chief Executive Officer of the market regulator, SASRA, Mr. John Mwaka. Welcome on set.
Thank you, Julian.
Looking at the non-deposit-taking Sacco regulations, this clearly changes the landscape as far as your purview of oversight is concerned. How is this likely to impact the sector as a whole?
Thank you very much for having me. And indeed, we commenced the regulation of non-deposit-taking Saccos, which we expect to be around 400 in number. That increases the number of regulated Saccos in the country by big margin. Currently, we are regulating 175. So if you add 400, that gives you about 575, close to 600. And we expect that number to increase by the time we close the year to around 600.
One of the challenges we've had in the past when it comes to matters of Sacco management, I'll remind you of an incident about 2 years ago where one came under headwinds, and when you follow up that, it is indicated that it is not under SASRA's mandate, it is under the State Department of Cooperatives. You go there, they tell you no, management of Saccos is actually a devolved function, so maybe you should be speaking to the county government. Does this now resolve that issue of a bloodline as to who should be overseeing what?
Absolutely, it resolves, and in fact, even in the past, we were working together with the county governments and the Office of the Commissioner for Cooperatives. Remember, Commissioner for Cooperatives sits in the board of directors of SASRA, and therefore there is close working relationship between both the Commissioner and the authority. While developing the non-deposit-taking regulations, including even deposit-taking Sacco regulations 2010, we worked together with the county government. The authority regulates the business. Saccos do the business of mobilizing savings and offering credit. So anything to do with financial regulation is a national government function.
And looking at the compliance duration given, which I think is about 6 months, I did a spot check just speaking to a few of them. Some are of the view that perhaps you should have lengthened this duration by a bit. Would that fly for you?
Well, I think that's we gave it a lot of thought. We went for 6 months instead of the previous deposit-taking Saccos. They were given a transition period of 4 years. But remember, the deposit-taking Saccos operate banking hall. So the requirement for them to set up the requirements for operating a banking hall is quite stringent as opposed to already back office operating Saccos. Majorly, the non-deposit-taking Saccos operate what we call back office. So they do not need very elaborate security issues to put in place systems that are very complex as opposed to deposit-taking Saccos. So 6 months really fair, given that they will just be doing the same business they were doing. It's only that now they will need to submit their returns to us every other 15th day of the month.
Liquidity management is a challenge that a number of Saccos face, and that is principally because of the asset-liability mismatch. So ideally, you lock in your deposits in what is a long-term facility, especially with the craze around real estate. When you read the regulations, as I was reading before this, do you feel confident that the provisions stipulated therein will actually address the challenges the industry faces?
The model that our country has adopted for Saccos is a little bit different from the model of other nations, for example, the United States of America or Canada or Australia. Our model is a bit different, where the deposits actually are used as collateral. And basically, the universe from where they draw their liquidity is quite limited to their members, because these deposits are the same money that is used to grant loans. So that, of course, gives a little bit of a liquidity challenge. And where there is that mismatch, which is actually very apparent in our model, they will have to look for external financing to bridge the gap where that mismatch is existing. Now, the new regulations do not anticipate that there's going to be a big problem in that they will continue doing the same business using the same liquidity. Meanwhile, what we are doing as an authority is that we are working on a central liquidity mechanism where Saccos then can be able to borrow from each other at short notice to bridge that liquidity challenge that they could be having. Meanwhile, still the law allows them to go for external financing to bridge any gap that exists. Well, we have seen quite improvement in terms of liquidity management in Saccos, given the requirements of prudential regulation that has now made them to build, to increase their reserves to be able to deal with their very emergency liquidity challenges also.
Mr. Mwako, you preempted my next question. When you talk about the central liquidity management facility, 2 years back we were having a conversation around structuring a scheme through which Saccos could have an intercycle lending, if I could call it, pretty much the same way the banks have the interbank lending. Because the situation as it is, if you speak to a number of players, they'll tell you the top tier Saccos are awash with liquidity, the smaller ones don't have, but there's no avenue through which they can do the lending. Exactly how far are we with this structuring, this arrangement?
Well, quite some work has gone into it. For the last 2 years, I've been looking at, we engaged a consultant to conduct a survey just to understand the requirements and if indeed that liquidity exists in the top tier Saccos, as is always been perceived to be, which has come out to be quite true. And just like any other financial institution, what Saccos in the top tier have been doing is, of course, to save, or rather to put it in the commercial banking sector, so to speak, and of course in other facilities such as TB and so forth. Now, we've looked at the situation, and now we've come up with that mechanism, which we should say that we are at an advanced stage. We've already looked at the law. We've proposed the necessary legal and regulatory amendments that need to be done for them to be able to do that. That Sacco A has some liquidity and goes to Sacco B, especially the smaller ones. Well, but just in case they default, then there was a problem. How do they address that? And any discrepancy that may arise, how do we conduct the arbitration? Now, with what we are doing now, because we are now at an advanced stage, as I have mentioned, these instruments right now are with the CS, is studying them with his legal team, with a view to giving their input. Before then, of course, we finally submit them to Attorney General to begin the process of legislation.
One of the issues a number of Saccos have raised with me is that because of the absence of this facility we're talking about, they are compelled to go to the banking side to tap into their credit. Now, the challenge is if you're borrowing from a bank at 16% and you can only lend at 12%, then there's a bit of a mismatch there when it comes to getting your margin. Would you say that this is a significant challenge facing the sector, or how do you assess it?
Well, it has been actually a challenge for Saccos that are going for external financing to bridge the gap of liquidity. But the regulations for deposit-taking Saccos and for non-deposit-taking Saccos requires them, if they are to borrow at, say, from Bank A, they borrow at, say, 10%, then there has to be a margin of 2% when they are giving. They must make some margin. They cannot borrow at 10% and issue the same at 10% then, because that does not make business sense. And that has been happening actually. And indeed, there has been a lot of negotiations. It's always been a business agreement between the Sacco and the financial institution, and the rates have been really friendly, so to speak. You find that Saccos majorly, their interest rate is about 12% or 1% on reducing balance per month. So they have been borrowing at around, say, 8–9% from commercial banking sector and giving the same between 10 to 12%. And therefore, they are making something for the organization.
And you did mention the prospect of consolidation within the Sacco space. I'd just like to get some clarity here. Is your view that then you know, the way we speak about the industry being overbanked, that we have too many players in the space, within the Sacco space, and perhaps there's need for consolidation within the industry?
It's our view as an authority that there is need for consolidation. And we are seeing that happening even without a legal framework in place. How is it happening? You find that if a big Sacco, for example, the top 10 Saccos, which control about 50% of the market, yes, the top 10 Saccos, if they are operating in an area, say they are operating, say, in Mombasa, in Nyeri, you find that the smaller Saccos tend to go for the members of those smaller Saccos, therefore reducing them, and ultimately they are forced sort of to wind up and join this other big one. So that is like a voluntary merging without necessarily the leadership of the two Saccos really negotiating on how they come together. But it's our view that we don't, for now, need to legislate consolidation, causing Saccos to merge, but we want to encourage them to consider this as a viable and a sustainable way of conducting their business. If they were to consolidate and create a strong Sacco with a strong asset base, then that gives them the fighting power to expand and offer better services to their members.
Even as you speak about widening the purview of SASRA, one key concern that exists is that SASRA is not adequately capacitated to actually provide this oversight, especially when you look at budgetary allocations. Is this a view you share, or do you think otherwise?
When we began, unlike our colleagues, you know, we've got 5 financial regulators in the country, and we, of course, we do have an MOU, and the 5 of us, we work closely together. We have meetings together, we compare notes with each other. You realize our colleagues, we look at CMA, you look at IRA, RBA, when they began, they got seed capital. For us, unfortunately, that was something that we did not enjoy. That, of course, didn't give us a very strong footing when we began our operations. But over time, of course, the levies that we received from the Saccos have enabled us to create the necessary structures that have enabled us to operate from 2010 to date. We have had financing from government, but not much as we would expect. But for the last 2 years, we've not been able to receive exchequer from government. And so we do hope that we've already submitted our request to the National Treasury through our parent ministry, and we hope this is going to be considered. However, we've had a fantastic support from World Bank through a program that is that National Treasury Financial Sector Support Program.
Right, and that point by Mr. Mwaka takes us to a short break. Business Redefined will be back with a lot more on this conversation. Don't touch that dial. Welcome back to Business Redefined, your weekly most comprehensive look at the world of business and economics. And today, I should say, we're looking at the Sacco movement, and we are privileged to have the Chief Executive Officer of the Market Regulator, SASRA, Mr. John Mwaka. Welcome back on set.
Thank you very much, Julian.
In light of the COVID-19 shock, if you look at your peers in the financial services space, there's been a lot of capital preservation, and a number of players, say in the banking sector, have suspended dividends for shareholders. We are now in the dividend cycle for the Saccos. Have you given any guidance around this to members?
Indeed, just like any other financial institution or sector, Saccos have also been impacted by COVID during the year that just has ended. But in terms of capital preservation, in terms of payment of dividends, we are handling each case on its own merit. And we have instructed Saccos, of course, that they need to preserve a bit of their dividends that they're supposed to pay to their members. But given that the shock wasn't as was expected, in fact, if I were just to give some very brief information about our performance, remember our NPLs weren't affected as much as the financials, other than the banking sector, so to speak. Remember, 2019, we closed with the NPLs of about 6.15. For the year ended 2020, December 31st, we closed with 6.49. That was a slight increment of the non-performing loans. That basically means that the Saccos performed quite well. In fact, the growth was about 12% even during COVID. But I know and understand that the effects of COVID-19 are now really starting to be felt within the economy. So basically, we are encouraging Saccos not to really pay their dividends as they have declared in their financial statements for the year ended 31st December 2020. So we looking at every case on its own merit. But we have seen Saccos actually in their financial statements, they have reduced by about 10% as opposed to the year that ended 2019, December 31st.
Speaking to the issue of asset quality, which you have brought up and the comparison drawn between the banking side and the Sacco movement, granted, definitely, we've seen a larger increase in the banking sector than we have in the Sacco movement. But the counter-narrative to that, Mr. Mwaka, is that banks were a lot more aggressive when it comes to sustaining lending in light of COVID vis-a-vis Saccos, which I think assumed a very guarded position because of their risk profiling. Don't you think then that raises questions? Because if you look at the loan book growth, for instance, a number of Saccos will tell you we assumed a very cautious position because we just didn't know how this is going to unfold.
They did. In fact, Saccos went slow in terms of loaning. And indeed, most of the loans that they issued were short-term loans. They are 6 months, 1 year. But basically, so to speak, when you look at the performance of most of the Saccos, which are government-based, remember the most affected sectors were in aviation, horticulture, basically in agriculture, and hospitality industry. But most of the big players in this industry are Saccos that are within public sector. And say communication, like say Safaricom, and say Nation Media with their Nation Sacco and so forth. So when you look at the performance of these Saccos, they were fairly not affected so much by the shocks that occurred as a result of COVID-19. So basically, there could be a counter-narrative, but the model of business that Saccos normally have is quite different from the model that is actually adopted by the banking sector, so to speak. Remember, we deal with the members. We don't deal with the non-members. And so we really understand the profiling of our risk is well understood because we do not have walk-in and walk-out, so to speak, members. And so we realize that performance was fairly good.
When you look at the sector's loan book, and in this case I'm mentioning deposit taking because non-deposit taking are still just getting on board, to what degree would you say you've witnessed impairment due to COVID-19 in terms of a quantum of it?
Well, I should say I think about 10% you can say those were the impaired assets within the industry. 10% or between 9 and 10%. So it wasn't really significant, so to speak.
And one question I often get is that we've had so much of restructuring of loans, reprofiling, but we don't seem to get as much of this visibility from the Sacco movement. Has this been done, by the way, in light of COVID?
Well, we had a bit of that, but with the Saccos that are in the sectors that were really affected, the others were not very significant. The restructuring wasn't more than, it was about between 23 and 25 billion out of a possible 620 billion asset base, or about 600 loan book within the entire sector. So that it wasn't very significant. It was slightly less than 30 billion restructured loans.
And how is the sector's deposit book? And why that question is critical at this point is because there is the pervasive perception that many of those who are affected by COVID-19 in terms of loss of jobs then went to their Saccos to get their deposits to try and tide through the crisis as they looked for what else to do by way of gainful employment. How have you seen the deposit book evolve, especially looking at 2019, 2020, now just starting 21?
As I indicated earlier, it is just a small segment of the Sacco sector that was affected by COVID, especially the ones that I've mentioned, aviation, especially KQ, what happened in the agricultural area, horticultural area, because now, of course, there was no movement across and transport. About 2 Saccos that are in transport sector. So basically, they want quite a number. So basically, we saw a number of members really using their deposits to pay their loans. They didn't want to have a non-performing loan, so they were requesting the Saccos, the deposit that are built over time, to be now transferred to clear the loans that are there. Now, for organizations that had their income cut by half or suspended as a whole, we requested that they restructure so that we don't experience a big spike in unperforming loans. And now we are seeing that slowly they are getting back to gainful employment, and we are seeing them now building their deposits again. So it wasn't really a significant amount of deposit that were withdrawn to cater, of course, for the shocks that were existing.
Final question, Mr. Mwaka. Let's talk about efficiency within the Sacco movement. When you look at the industry's cost-to-income ratio and how it has evolved over time, how comfortable would you say you are as far as that is concerned?
We've seen a lot of improvement in terms of adoption of IT systems. When we came, I should say, 65% of the cost of running Saccos at that time was on what we call governance. And that was quite high. These have come down to less than 50%, actually 40%, a big improvement in terms of the cost of running these institutions. Now, in terms of efficiency, when you look at the ratio of income vis-a-vis the assets that have been put in place, or rather they have been invested, well, we should say that it is not where I would expect them to be. There is room for improvement. They are not doing very well. We expect them to improve their systems. We have seen quite a number of them now have moved almost from manual systems. Now they are on proper IT systems, and that is going to help them really deliver new and innovative product to their members. But without full adoption of systems that are secure and resilient, we still expect them to have a bit of trouble. So basically for deposit-taking Saccos, we are seeing quite a bit of improvement, and we expect that they are going to improve further because room for improvement still exists.
And that point by Mr. Mwaka takes us to the close of our conversation on Business Redefined, where we have been focusing on the Sacco movement and particularly the new regulations regarding non-deposit-taking Saccos.